Welcome to Simple Understanding channel. I hope that you enjoy the course of CPIM with us. Please don't forget to like and subscribe to our channel and share your comment below. In this video, we will continue with Module 6, Inventory, which consists of 4 sections as the following. Section A, Inventory Planning. Section B, Inventory and Product Costs, Value, and Metrics. Section C, Itemized Inventory Management. Section D, Inventory Control. Let's begin with Section A, Inventory Planning. Overview. Inventory planning involves the strategic management of inventory levels to balance supply and demand while minimizing costs and maximizing service levels. This section focuses on the principles, techniques, and best practices for effective inventory planning to support operational efficiency and customer satisfaction. Key topics. Importance of inventory planning. A. Balancing supply and demand. Inventory planning helps ensure that the right amount of inventory is available to meet customer demand without excess or shortage. Example: a toy retailer plans inventory levels based on seasonal demand forecasts, ensuring popular toys are stocked in time for the holiday season. B. Reducing inventory costs. Effective inventory planning minimizes carrying costs, such as storage and insurance, and reduces the risk of obsolete inventory. Example: a consumer electronics company uses inventory planning to optimize stock levels and reduce costs associated with storing unsold products. C. Improving service levels. Proper inventory planning enhances customer service by ensuring that products are available when customers need them, improving satisfaction and loyalty. Example: an online retailer uses inventory planning to maintain adequate stock levels of high-demand items, ensuring timely fulfillment of customer orders. Techniques for inventory planning. A. Economic Order Quantity, EOQ. EOQ is a formula used to determine the optimal order quantity that minimizes the total inventory costs, including ordering and holding costs. Example: a pharmaceutical company uses EOQ to calculate the optimal order size for its medication inventory, balancing the costs of ordering and storing drugs. B. Just-in-time, JIT, inventory. JIT inventory aims to reduce inventory levels by ordering materials and products only as needed, aligning closely with production schedules. Example: Toyota implements JIT to minimize inventory holding costs and streamline its production process, ordering parts just before they are needed on the assembly line. C. Reorder Point, ROP. ROP is the inventory level at which a new order should be placed to replenish stock before it runs out, based on lead time and demand. Example: a grocery store sets a reorder point for essential items like milk and bread to ensure that new stock arrives before current inventory is depleted. D. Safety stock. Safety stock is an additional quantity of inventory held to account for uncertainties in demand or supply, reducing the risk of stockouts. Example: an electronics retailer maintains safety stock for high-demand gadgets to prevent stockouts during unexpected spikes in demand. Inventory planning strategies. A. Demand forecasting. Accurate demand forecasting helps predict future inventory needs based on historical data, trends, and market conditions. Example: a fashion retailer uses historical sales data and trend analysis to forecast demand for seasonal clothing lines, planning inventory accordingly. B. ABC analysis. ABC analysis categorizes inventory into 3 groups, A, B, and C, based on importance and value, allowing for prioritized management. Example: a manufacturing company classifies its inventory into A. high-value items, B. moderate-value items, and C. low-value items, focusing more resources on managing A items. C. Periodic versus perpetual inventory systems. Periodic systems involve physical counts of inventory at regular intervals, while perpetual systems continuously track inventory levels in real time. Example: A warehouse uses a perpetual inventory system to monitor stock levels and update records in real time, while a small retail store may perform periodic physical counts. D. Inventory turnover ratio. The inventory turnover ratio measures how often inventory is sold and replaced over a period, indicating the efficiency of inventory management. Example: a bookstore calculates its inventory turnover ratio to assess how quickly books are sold and replaced, helping to optimize inventory levels. Best practices for inventory planning. A. Regular review and adjustment. Regularly review inventory levels and adjust plans based on changes in demand, supply chain disruptions, or market conditions. Example: a technology company reviews inventory levels quarterly and adjusts orders based on new product releases and shifts in consumer preferences. B. Collaboration with suppliers. Collaborate closely with suppliers to ensure timely delivery of materials and products, and to align inventory planning with supply chain capabilities. Example: an apparel manufacturer works with its suppliers to coordinate delivery schedules and manage inventory levels based on production needs. C. Implementing technology. Utilize inventory management software and tools to track inventory levels, forecast demand, and automate replenishment processes. Example: a large retailer uses inventory management software to track stock levels across multiple locations and automate reorder processes. D. Analyzing inventory data. Analyze inventory data to identify trends, patterns, and potential issues, and use this information to improve inventory planning and decision-making. Example: a home goods retailer analyzes sales data to identify slow-moving items and adjust inventory levels to reduce excess stock. Challenges in inventory planning. A. Demand variability. Fluctuations in customer demand can complicate inventory planning, requiring adjustments to avoid stockouts or overstocking. Example: a toy manufacturer experiences variability in demand during holiday seasons, requiring careful inventory planning to meet fluctuating customer needs. B. Supply chain disruptions. Disruptions in the supply chain, such as delays or shortages, can impact inventory levels and require contingency planning. Example: a food manufacturer faces supply chain disruptions due to natural disasters, requiring adjustments to inventory plans to mitigate the impact. C. Managing lead times. Variability in lead times can affect inventory planning, requiring accurate forecasting and buffer stock to address potential delays. Example: an auto parts distributor manages lead times from international suppliers, incorporating buffer stock to handle potential delays in delivery. D. Balancing costs and service levels. Finding the right balance between inventory costs and service levels can be challenging, requiring careful planning and analysis. Example: a retail chain balances inventory costs and service levels by using data analysis to optimize stock levels and reduce carrying costs while maintaining high service standards. Real-world examples. Manufacturing. General Electric uses inventory planning techniques to manage complex supply chains and ensure timely availability of components for its diverse range of products. Retail. Walmart employs sophisticated inventory planning strategies to manage its extensive inventory across thousands of stores, ensuring product availability and cost efficiency. Healthcare. CVS Health uses inventory planning to manage pharmaceutical and medical supplies, ensuring timely availability of products while minimizing excess inventory and related costs. In summary, inventory planning is a critical component of supply chain management, involving strategies and techniques to balance supply and demand, reduce costs, and improve service levels. By implementing best practices and addressing challenges, organizations can optimize their inventory management and achieve operational success. Section A. Inventory Planning Practice Test. 1. What is the main objective of inventory planning? A. To increase product prices. B. To ensure adequate stock levels and minimize carrying costs. C. To decrease production speed. D. To maximize employee overtime. Correct answer, B. Overall explanation. The main objective of inventory planning is to ensure adequate stock levels while minimizing carrying costs and avoiding stockouts. 2. Which method is commonly used to determine reorder points? A. Economic order quantity, EOQ. B. Just-in-time, JIT. C. Safety stock calculation. D. Inventory turnover ratio. Correct answer, C. Overall explanation. Reorder points are commonly determined using safety stock calculations to ensure there is enough inventory before reordering. 3. How does forecasting impact inventory planning? It has no effect. B. It helps predict future demand to adjust inventory levels accordingly. C. It increases inventory holding costs. D. It reduces the accuracy of stock levels. Correct answer, B. Overall explanation. Forecasting helps predict future demand, which is crucial for adjusting inventory levels and ensuring sufficient stock availability. 4. What is a key benefit of implementing an inventory management system? A. Increased manual tracking. B. Reduced visibility of inventory levels. C. Improved inventory accuracy and efficiency. D. Increased stockouts. Correct answer, C. Overall explanation. An inventory management system improves inventory accuracy and efficiency by automating tracking and providing real-time data. 5. What is the purpose of safety stock in inventory planning? A. To reduce order quantities. B. To ensure sufficient inventory during demand fluctuations. C. To minimize inventory carrying costs. D. To increase the order lead time. Correct answer, B. Overall explanation. Safety stock is used to ensure sufficient inventory during fluctuations in demand and to avoid stockouts. 6. How does inventory turnover ratio affect inventory planning? A. It has no impact. B. It helps assess how efficiently inventory is used and replenished. C. It decreases the need for accurate forecasting. D. It increases storage costs. Correct answer, B. Overall explanation. The inventory turnover ratio helps assess how efficiently inventory is used and replenished, providing insights for better inventory planning. 7. What is the role of economic order quantity, EOQ, in inventory planning? A. To determine optimal order quantities. B. To increase lead times. C. To reduce safety stock levels. D. To track inventory turnover. Correct answer, A. Overall explanation. EOQ helps determine the optimal order quantity that minimizes total inventory costs, including ordering and carrying costs. 8. Which of the following is a challenge in inventory planning? Accurate demand forecasting. B. Increased automation. C. Improved stock visibility. D. Reduced carrying costs. Correct answer, A. Overall explanation. Accurate demand forecasting is a challenge in inventory planning as it directly impacts inventory levels and ordering decisions. 9. How does the just-in-time, JIT, inventory system affect inventory levels? A. It increases inventory levels. B. It reduces inventory levels by ordering materials only as needed. C. It has no effect on inventory levels. D. It requires higher safety stock. Correct answer, B. Overall explanation. JIT reduces inventory levels by ordering materials only as needed, minimizing excess stock and carrying costs. 10. What is the impact of lead time on inventory planning? A. It decreases safety stock needs. B. It affects the timing of inventory replenishment. C. It has no effect on inventory levels. D. It simplifies demand forecasting. Correct answer, B. Overall explanation. Lead time affects the timing of inventory replenishment, impacting when orders need to be placed to avoid stockouts. Section B, Inventory and Product Costs, Value, and Metrics. Overview. This section focuses on understanding the relationship between inventory management, product costs, value, and key metrics used to evaluate inventory performance. It provides insights into how inventory costs impact overall business performance and how various metrics can be used to monitor and optimize inventory levels. Key topics. Inventory costs. A. Types of inventory costs. Inventory costs include several components: carrying costs, ordering costs, and stockout costs. Example: a clothing retailer incurs carrying costs for storing unsold garments, ordering costs for replenishing stock, and stockout costs when popular items are out of stock. B. Carrying costs. These are the costs associated with holding inventory, including warehousing, insurance, and obsolescence. Example: a warehouse storing electronics incurs costs for space rental, insurance, and potential depreciation of tech products. C. Ordering costs. Costs related to placing and receiving inventory orders, including administrative expenses and transportation. Example: a pharmaceutical company pays for shipping and handling when ordering drug supplies from manufacturers. D. Stockout costs. Costs incurred when inventory levels are insufficient to meet customer demand, leading to lost sales and customer dissatisfaction. Example: an online retailer faces stockout costs when a popular item is unavailable, resulting in lost sales and customer frustration. Product costs. A. Direct costs. These include costs directly associated with producing or purchasing inventory items, such as raw materials and labor. Example: a furniture manufacturer includes the costs of wood, fabric, and labor in the direct costs of producing a sofa. B. Indirect costs. Costs not directly tied to production but necessary for operations, including overheads like utilities and administrative expenses. Example: a factory's utility bills and facility maintenance are indirect costs factored into the overall cost of producing goods. C. Fixed costs. Costs that remain constant regardless of production volume, such as rent and equipment depreciation. Example: a production plant pays fixed costs for machinery maintenance and factory rent, regardless of the number of units produced. D. Variable costs. Costs that fluctuate with production volume, including materials and direct labor costs. Example: the cost of raw materials and labor for assembling a car varies with the number of vehicles produced. Value of inventory. A. Valuation methods. Inventory valuation methods include FIFO, first in, first out, LIFO, last in, first out, and weighted average cost. Example: a grocery store uses FIFO to ensure that older stock, e.g., perishable goods, is sold before newer stock. B. FIFO, first in, first out, assumes that the oldest inventory items are sold first, impacting cost of goods sold, COGS, and inventory valuation. Example: a bakery uses FIFO to sell bread baked earlier before selling freshly baked loaves. C. LIFO, last in, first out, assumes that the most recently purchased items are sold first, which can affect financial statements and tax implications. Example: an industrial supplier uses LIFO to sell the newest stock of tools before older inventory. D. Weighted average cost. Calculates the average cost of inventory items, providing a more consistent valuation approach. Example: a retailer calculates the weighted average cost of electronics to determine inventory value and COGS. Inventory metrics. A. Inventory turnover ratio. Measures how often inventory is sold and replaced over a period, indicating inventory efficiency. Example: a bookstore calculates its inventory turnover ratio to assess how quickly books are sold and replenished. B. Days sales of inventory, DSI. Measures the average number of days it takes to sell inventory, helping to evaluate inventory management efficiency. Example: A clothing retailer tracks DSI to understand how long it takes to sell seasonal apparel and adjust purchasing decisions. C. Gross margin return on investment, GMROI. Measures the profitability of inventory by comparing gross margin to the cost of inventory. Example: a jewelry store calculates GMROI to assess the profitability of its inventory and make informed purchasing decisions. D. Stockout rate. The percentage of times inventory is unavailable when needed, reflecting on inventory planning and customer service. Example: an electronics retailer monitors stockout rates to improve inventory levels and avoid customer dissatisfaction. Best practices for managing costs and metrics. A. Regular cost analysis. Continuously analyze inventory costs to identify opportunities for cost reduction and efficiency improvements. Example: a manufacturing company conducts regular cost analysis to reduce overheads and lower production costs. B. Accurate valuation. Use appropriate inventory valuation methods to ensure accurate financial reporting and inventory management. Example: a food manufacturer applies FIFO to ensure accurate cost calculations and minimize spoilage. C. Performance monitoring. Monitor key inventory metrics regularly to assess performance and make data-driven decisions. Example: a retailer tracks inventory turnover and DSI to optimize stock levels and improve inventory management. D. Cost control measures. Implement measures to control and reduce inventory-related costs, including better forecasting and efficient inventory practices. Example: a technology company improves forecasting accuracy and inventory practices to control carrying costs and reduce excess inventory. Challenges in managing inventory costs and metrics. A. Fluctuating costs. Variability in inventory costs due to market changes, supply chain disruptions, or changes in production processes. Example: an automotive manufacturer faces fluctuating costs for raw materials due to changes in market prices and supply chain issues. B. Data accuracy. Ensuring accurate data for inventory valuation and cost calculations to avoid discrepancies and make informed decisions. Example: a retail chain invests in inventory management systems to improve data accuracy and avoid discrepancies in inventory valuation. C. Balancing costs and service levels. Finding the right balance between managing inventory costs and maintaining high service levels for customers. Example: a consumer goods company balances inventory costs with service levels by optimizing stock levels to meet customer demand without overstocking. D. Managing obsolete inventory. Handling inventory that is no longer sellable or has become obsolete due to changes in market demand or product updates. Example: a technology company deals with obsolete inventory by offering discounts or liquidating outdated products to clear space for new stock. Real-world examples. Retail. Amazon uses sophisticated inventory management and cost control practices to optimize its vast inventory and ensure timely delivery of products while managing costs effectively. Manufacturing. Ford Motor Company applies inventory and product cost management techniques to control production costs and optimize inventory levels across its global supply chain. Healthcare. McKesson Corporation manages inventory costs and metrics to ensure the availability of pharmaceutical products while minimizing costs and improving operational efficiency. In summary, effective management of inventory costs, value, and metrics is crucial for optimizing inventory performance and supporting overall business success. By understanding and applying key concepts and best practices, organizations can achieve better control over inventory-related costs and improve their inventory management strategies. Section B. Inventory and product costs, value, and metrics. 1. What is the primary purpose of calculating inventory carrying costs? A. To assess employee performance. B. To determine the cost of holding inventory. C. To calculate production costs. D. To track sales performance. Correct answer, B. Overall explanation. The primary purpose of calculating inventory carrying costs is to determine the cost associated with holding inventory, which helps in making informed inventory management decisions. 2. How does inventory turnover ratio help in assessing product value? It shows how often inventory is sold and replaced. B. It measures the cost of production. C. It indicates the quality of the products. D. It calculates the demand forecast accuracy. Correct answer, A. Overall explanation. Inventory turnover ratio helps in assessing how frequently inventory is sold and replaced, providing insights into product value and inventory efficiency. 3. What is included in the total cost of inventory? A. Only the purchase cost. B. Purchase cost, carrying costs, and ordering costs. C. Just the carrying costs. D. Only the ordering costs. Correct answer, B. Overall explanation. The total cost of inventory includes purchase cost, carrying costs, and ordering costs, providing a comprehensive view of inventory expenses. 4. How do product costs impact inventory valuation? A. They are irrelevant to inventory valuation. B. They directly affect the calculation of inventory value. C. They only impact the sale price. D. They have no impact on financial statements. Correct answer, B. Overall explanation. Product costs, including purchase and production costs, directly affect the calculation of inventory value, which is crucial for accurate financial reporting. 5. Which metric is commonly used to evaluate inventory performance? A. Gross margin return on investment, GMROI. B. Customer satisfaction score. C. Employee productivity rate. D. Return on assets, ROA. Correct answer, A. Overall explanation. Gross margin return on investment, GMROI, is a key metric used to evaluate inventory performance by measuring the profitability of inventory investments. 6. How does the carrying cost of inventory affect financial performance? A. It improves profitability. B. It has no effect. C. It increases expenses and reduces profitability. D. It enhances cash flow. Correct answer, C. Overall explanation. Carrying costs increase expenses and reduce profitability as they represent the costs associated with holding inventory over time. 7. What is the significance of inventory valuation methods such as FIFO and LIFO? A. They determine the level of inventory accuracy. B. They impact the calculation of cost of goods sold and ending inventory. C. They measure customer demand. D. They affect production scheduling. Correct answer, B. Overall explanation. Inventory valuation methods like FIFO, first in, first out, and LIFO, last in, first out, impact the calculation of cost of goods sold and ending inventory, affecting financial statements. 8. What role does product cost play in inventory metrics? A. It is not considered. B. It influences metrics like GMROI and inventory turnover. C. It only affects production schedules. D. It impacts marketing strategies. Correct answer, B. Overall explanation. Product cost plays a critical role in inventory metrics such as GMROI and inventory turnover, influencing profitability and efficiency evaluations. 9. Why is it important to monitor inventory metrics regularly? A. To increase carrying costs. B. To ensure accurate financial reporting and optimize inventory management. C. To reduce product quality. D. To increase employee workload. Correct answer, B. Overall explanation. Monitoring inventory metrics regularly ensures accurate financial reporting and helps optimize inventory management by providing insights into performance and efficiency. 10. What is the impact of high inventory carrying costs on a business? A. increased profitability. B. Reduced cash flow and lower profitability. C. Enhanced customer satisfaction. D. Improved production efficiency. Correct answer, B. Overall explanation. High inventory carrying costs reduce cash flow and lower profitability by increasing the expenses associated with holding inventory. Please don't forget to like and subscribe to our channel and share your comment below. Section C. Itemized Inventory Management. Overview. Itemized inventory management involves tracking and controlling inventory items at a detailed level to ensure accurate stock levels, optimize inventory turnover, and reduce carrying costs. This section covers techniques for managing individual inventory items, assessing their impact on overall inventory performance, and applying best practices for item-level control. Key topics. Detailed tracking of inventory items. A. Item-level tracking. Monitoring inventory items individually to ensure precise control over stock levels, movements, and locations. Example. A warehouse uses barcode scanning to track each item's location and movement, improving inventory accuracy and reducing errors. B. SKU management. Managing stock-keeping units, SKUs, to identify and track unique items within inventory, aiding in detailed inventory control. Example. A retail store uses SKUs to manage different sizes and colors of clothing, allowing for efficient stock management and reordering. C. Real-time inventory updates. Implementing systems that update inventory levels in real time to reflect current stock availability and movements. Example. An e-commerce platform integrates real-time inventory updates to ensure that product availability is accurately displayed to customers. D. Tracking inventory costs. Monitoring costs associated with individual items, including acquisition costs, carrying costs, and storage fees. Example. A manufacturing company tracks the cost of raw materials per SKU to analyze the profitability of each product line. Inventory valuation techniques. A. Cost methodologies. Applying different cost methodologies such as FIFO, first in, first out, LIFO, last in, first out, and weighted average to value inventory items. Example. A grocery store uses FIFO to ensure that perishable items are sold before newer stock, affecting inventory valuation and cost of goods sold. B. Tracking obsolete inventory. Identifying and managing obsolete or slow-moving inventory to minimize losses and free up valuable storage space. Example. An electronics retailer tracks and discounts outdated gadgets to clear space for new models. C. Inventory turnover ratio. Measuring how quickly inventory items are sold and replaced over a period, which helps assess the efficiency of inventory management. Example. A fashion retailer calculates inventory turnover to optimize stock levels and improve sales performance. D. Inventory carrying costs. Calculating the costs associated with holding inventory, including storage, insurance, and obsolescence. Example. A pharmaceutical company assesses carrying costs to determine the impact on profitability and make informed purchasing decisions. Stock replenishment strategies. A. Reorder point system. Establishing reorder points for inventory items to trigger automatic replenishment when stock levels fall below a predetermined threshold. Example. A hardware store sets reorder points for popular tools to ensure that stock levels are maintained and avoid stockouts. B. Economic order quantity, EOQ. Calculating the optimal order quantity that minimizes the total cost of ordering and holding inventory. Example. A manufacturer uses EOQ to determine the most cost-effective order quantity for raw materials, balancing ordering costs with carrying costs. C. Just-in-time, JIT, inventory. Implementing JIT to reduce inventory levels and carrying costs by receiving goods only as they are needed in the production process. Example. Toyota employs JIT to minimize inventory levels and reduce storage costs while maintaining efficient production operations. D. Safety stock levels. Maintaining safety stock to account for variability in demand and supply lead times, ensuring that inventory levels are sufficient to meet unexpected changes. Example: an online retailer keeps safety stock for high-demand products to prevent stockouts during peak sales periods. Inventory auditing and reconciliation. A. Regular inventory audits. Conducting periodic audits to verify the accuracy of inventory records and reconcile discrepancies. Example: a warehouse performs monthly inventory audits to ensure that physical stock matches recorded levels and address any discrepancies. B. Cycle counting. Implementing cycle counting as an ongoing inventory audit process to regularly count a subset of inventory items and identify issues early. Example: a distribution center conducts weekly cycle counts for high-value items to ensure accuracy and reduce the impact of inventory errors. C. Inventory reconciliation. Comparing physical inventory counts with recorded levels to identify and resolve discrepancies, ensuring accurate inventory management. Example: a retail chain reconciles physical counts with inventory records to address discrepancies and maintain accurate stock levels. D. Discrepancy investigation. Investigating and addressing causes of inventory discrepancies, such as theft, data entry errors, or supply chain issues. Example: a grocery store investigates discrepancies found during inventory reconciliation to identify causes and prevent future issues. Challenges in itemized inventory management. A. Managing large volumes of SKUs. Handling a large number of SKUs can complicate inventory management and require sophisticated tracking and control systems. Example: a multinational retailer manages thousands of SKUs across multiple locations, necessitating advanced inventory management systems to ensure accuracy. B. Variability in demand. Addressing fluctuations in demand for individual items, which can impact inventory levels and require dynamic adjustment of stock levels. Example: a toy store experiences seasonal demand spikes, requiring adjustments to inventory levels to meet customer needs during peak periods. C. Inventory shrinkage. Dealing with inventory loss due to theft, damage, or administrative errors, which can affect overall inventory accuracy and profitability. Example: a warehouse implements security measures and improves inventory tracking to reduce shrinkage and maintain accurate stock levels. D. Technology integration. Integrating inventory management systems with other business systems to ensure seamless data flow and accurate inventory tracking. Example: an e-commerce company integrates its inventory management system with its order processing and accounting systems for better visibility and control. Real-world examples. Retail. Walmart uses sophisticated item-level tracking and inventory management systems to ensure efficient stock management and minimize out-of-stock situations. Manufacturing. Boeing employs detailed inventory management techniques to track and manage thousands of components used in aircraft production, ensuring timely availability and reducing production delays. Healthcare. CVS Health uses itemized inventory management to track pharmaceutical products and ensure availability while managing costs and minimizing wastage. In summary, itemized inventory management is crucial for maintaining accurate inventory records, optimizing stock levels, and controlling costs. By applying detailed tracking methods, valuation techniques, and replenishment strategies, organizations can effectively manage inventory items and support overall operational efficiency. Section C. Itemized inventory management. 1. What is itemized inventory management? Managing inventory in bulk. B. Tracking individual inventory items. C. Ignoring inventory tracking. D. Relying on manual inventory counts. Correct answer: B. Overall explanation. Itemized inventory management involves tracking each individual inventory item separately to ensure accurate records and control. 2. Why is itemized inventory management important? A. It reduces the need for inventory tracking. B. It improves accuracy and control over inventory. C. It increases manual handling. D. It simplifies production scheduling. Correct answer, B. Overall explanation. Itemized inventory management is important because it improves accuracy and control over inventory by monitoring each item individually. 3. Which technology is commonly used in itemized inventory management? Barcode scanning. B. Voice recognition. C. Augmented reality. D. Manual ledger. Correct answer, A. Overall explanation. Barcode scanning is commonly used in itemized inventory management to track and manage individual inventory items efficiently. 4. How does itemized inventory management affect inventory accuracy? A. It decreases accuracy. B. It has no impact. C. It improves accuracy. D. It complicates inventory tracking. Correct answer, C. Overall explanation. Itemized inventory management improves accuracy by ensuring detailed tracking of each individual item, reducing errors and discrepancies. 5. What is the role of itemized inventory management in reducing stockouts? A. It has no impact on stockouts. B. It increases the likelihood of stockouts. C. It helps identify low stock levels early. D. It delays inventory replenishment. Correct answer, C. Overall explanation. Itemized inventory management helps identify low stock levels early, which assists in preventing stockouts and maintaining inventory levels. 6. Which of the following is a benefit of itemized inventory management? A. Reduced inventory turnover. B. Improved order accuracy. C. Increased manual counting. D. Higher carrying costs. Correct answer, B. Overall explanation. A key benefit of itemized inventory management is improved order accuracy, as it allows for precise tracking and management of inventory items. 7. How does itemized inventory management support inventory audits? It makes audits more complex. B. It has no effect on audits. C. It simplifies audits by providing detailed records. D. It increases the time required for audits. Correct answer, C. Overall explanation. Itemized inventory management supports inventory audits by providing detailed records, making the audit process simpler and more accurate. 8. What is a common challenge of itemized inventory management? Enhanced tracking accuracy. B. Increased complexity in tracking. C. Decreased inventory visibility. D. Improved inventory turnover. Correct answer, B. Overall explanation. A common challenge of itemized inventory management is increased complexity in tracking due to the need to manage each individual item separately. 9. Which method is used to maintain itemized inventory records? Random sampling. B. Periodic reviews. C. Perpetual inventory system. D. Ad hoc checks. Correct answer, C. Overall explanation. The perpetual inventory system is used to maintain itemized inventory records continuously, providing real-time updates on inventory levels. 10. How does itemized inventory management affect customer satisfaction? It decreases satisfaction. B. It has no impact. C. It can increase satisfaction by reducing errors in orders. D. It complicates the order process. Correct answer, C. Overall explanation. Itemized inventory management can increase customer satisfaction by reducing errors in orders and ensuring that the correct items are available when needed. Section D. Inventory Control. Overview. Inventory control focuses on managing and regulating stock levels to ensure that the right amount of inventory is available to meet customer demand while minimizing carrying costs and reducing the risk of stockouts or excess inventory. This section covers techniques, strategies, and best practices for effective inventory control. Key topics: inventory control techniques. A. ABC analysis classifies inventory items into 3 categories, A, B, and C, based on their importance and value, with A items being the most valuable and C items being the least. Example: a retailer uses ABC analysis to prioritize inventory management efforts on high-value items, A, and reduce focus on low-value items, C, optimizing resource allocation. B. Economic order quantity, EOQ, determines the optimal order quantity that minimizes the total cost of ordering and holding inventory. Example: a manufacturer calculates EOQ to order raw materials in quantities that balance ordering costs with holding costs, reducing overall inventory expenses. C. Just-in-time, JIT, inventory, reduces inventory levels by receiving goods only as they are needed in the production process, minimizing storage costs. Example: Toyota uses JIT to synchronize production schedules with supplier deliveries, reducing inventory levels and improving efficiency. D. Reorder point system establishes a minimum stock level at which new orders are triggered to replenish inventory before it reaches a critical level. Example: an online store sets reorder points for high-demand products to automatically reorder stock when inventory levels fall below a predetermined threshold. Inventory tracking and monitoring. A. Real-time inventory tracking utilizes technology such as barcode scanning and RFID to monitor inventory levels and movements in real time. Example: Amazon employs real-time tracking with RFID tags to ensure accurate inventory management and efficient order fulfillment. B. Cycle counting conducts regular counts of a subset of inventory items to verify accuracy and identify discrepancies without performing a full physical inventory. Example: a warehouse performs daily cycle counts on high-value items to maintain accurate inventory records and quickly address discrepancies. C. Inventory audits periodically verifies the physical inventory against recorded levels to ensure accuracy and compliance with accounting standards. Example: a retail chain conducts quarterly inventory audits to reconcile physical counts with system records and address any discrepancies. D. Automated inventory systems implements software solutions to automate inventory tracking, reporting, and management, reducing manual errors and improving efficiency. Example: a manufacturing company uses an automated inventory management system to streamline stock control and enhance data accuracy. Inventory optimization strategies. A. Safety stock management maintains extra inventory as a buffer to account for variability in demand and supply chain disruptions. Example: a pharmaceutical distributor keeps safety stock for critical medications to prevent shortages during unexpected demand spikes. B. Demand forecasting utilizes historical data and predictive analytics to forecast future demand and adjust inventory levels accordingly. Example: a fashion retailer uses demand forecasting to plan inventory levels for seasonal trends and optimize stock replenishment. C. Stock rotation ensures that older inventory is sold before newer stock to prevent obsolescence and reduce waste. Example: a grocery store uses FIFO, first in, first out, to rotate perishable goods, ensuring that older products are sold before newer arrivals. D. Inventory segmentation divides inventory into categories based on characteristics such as demand frequency, value, or shelf life to apply different management strategies. Example: a warehouse segments inventory into fast-moving, slow-moving, and non-moving categories to optimize storage and replenishment practices. Handling stockouts and overstocks. A. Stockout prevention implements strategies to avoid stockouts, such as increasing safety stock or improving supplier lead times. Example: an electronics retailer improves supplier relationships and adjusts safety stock levels to prevent stockouts of popular devices. B. Overstock management. Addresses excess inventory by offering discounts, bundling products, or liquidating surplus stock. Example: a fashion retailer runs clearance sales to reduce overstock of last season's clothing and make room for new inventory. C. Inventory replenishment policies. Develops policies for inventory replenishment based on factors such as sales patterns, supplier reliability, and lead times. Example: a supermarket establishes replenishment policies for fast-moving items to ensure timely restocking and avoid stockouts. D. Supplier collaboration. Works closely with suppliers to improve lead times, order accuracy, and inventory visibility. Example: a manufacturer collaborates with suppliers to implement vendor-managed inventory, VMI, improving stock levels and reducing lead times. Challenges in inventory control. A. Demand variability. Managing fluctuations in customer demand that impact inventory levels and control measures. Example: a toy store faces challenges in managing inventory for popular holiday toys with unpredictable demand spikes. B. Supply chain disruptions. Addressing disruptions such as delays or shortages from suppliers that affect inventory levels. Example: a restaurant deals with supply chain disruptions by sourcing alternative suppliers and adjusting inventory levels to maintain operations. C. Technological integration. Integrating inventory control systems with other business systems for seamless data flow and accurate management. Example: an apparel retailer integrates inventory control with its e-commerce platform and POS system to ensure accurate stock levels across channels. D. Inventory accuracy. Ensuring accurate inventory records to prevent issues such as stockouts, overstocking, and financial discrepancies. Example: a distribution center implements rigorous inventory accuracy checks to maintain correct stock levels and reduce discrepancies. Real-world examples. Retail. Walmart uses advanced inventory control techniques, including real-time tracking and automated replenishment, to maintain optimal stock levels and reduce carrying costs. Manufacturing. General Electric employs inventory optimization strategies and safety stock management to ensure efficient production operations and minimize disruptions. Healthcare. CVS Health utilizes inventory control methods, such as automated systems and cycle counting, to manage pharmaceutical inventory and ensure timely availability of medications. In summary, inventory control involves a range of techniques and strategies to effectively manage stock levels, optimize inventory turnover, and address challenges such as demand variability and supply chain disruptions. By implementing best practices in inventory control, organizations can improve efficiency, reduce costs, and maintain accurate stock levels. Section D. Inventory control. 1. What is the primary goal of inventory control? A. To increase inventory levels. B. To ensure the availability of products while minimizing costs. C. To reduce employee turnover. D. To maximize production speed. Correct answer: B. Overall explanation. The primary goal of inventory control is to ensure that products are available when needed while minimizing costs associated with excess inventory. 2. Which technique is commonly used for inventory control? A. Lean manufacturing. B. Safety stock. C. Just-in-time JIT. D. Capacity planning. Correct answer: C. Overall explanation. Just-in-time JIT is a commonly used technique in inventory control that aims to minimize inventory levels and reduce holding costs by receiving goods only as they are needed. 3. What is safety stock in inventory control? Stock that is discarded. B. Stock kept to account for variability in demand or supply. C. Stock used for marketing purposes. D. Stock that is outdated. Correct answer: B. Overall explanation. Safety stock is the additional inventory kept to account for variability in demand or supply, helping to prevent stockouts and ensure availability. 4. How does inventory turnover relate to inventory control? Higher turnover indicates overstocking. B. Higher turnover indicates efficient use of inventory. C. Lower turnover indicates better control. D. Turnover has no impact on inventory control. Correct answer, B. Overall explanation. Higher inventory turnover indicates efficient use of inventory, as it means that inventory is sold and replenished quickly. 5. What is the purpose of cycle counting in inventory control? A. To reduce production lead times. B. To verify the accuracy of inventory records. C. To increase the number of inventory items. D. To improve supplier relationships. Correct answer, B. Overall explanation. Cycle counting is used to verify the accuracy of inventory records by regularly counting a portion of the inventory, ensuring data accuracy and reducing discrepancies. 6. Which inventory control method focuses on minimizing inventory holding costs? A. Economic order quantity, EOQ. B. Safety stock. C. Just-in-time JIT. D. Reorder point. Correct answer, A. Overall explanation. The economic order quantity, EOQ, method focuses on minimizing inventory holding costs by determining the optimal order quantity that balances ordering and holding costs. 7. What does the reorder point in inventory control signify? The level at which to increase inventory. B. The level at which to reorder inventory. C. The maximum allowable inventory level. D. The level at which to reduce production. Correct answer, B. Overall explanation. The reorder point signifies the inventory level at which a new order should be placed to replenish stock before it runs out. 8. How does inventory control impact customer service? A. It has no impact. B. It can improve customer service by ensuring product availability. C. It decreases customer service levels. D. It only impacts internal processes. Correct answer, B. Overall explanation. Effective inventory control can improve customer service by ensuring that products are available when needed, thus reducing stockouts and delays. 9. What is the primary benefit of implementing an automated inventory control system? A. Increased manual tracking. B. Enhanced accuracy and efficiency. C. Reduced inventory accuracy. D. Increased human error. Correct answer, B. Overall explanation. The primary benefit of an automated inventory control system is enhanced accuracy and efficiency in tracking inventory levels and managing stock. 10. How does effective inventory control affect overall business profitability? A. It reduces profitability. B. It has no effect on profitability. C. It improves profitability by reducing excess inventory costs. D. It only affects operational efficiency. Correct answer, C. Overall explanation. Effective inventory control improves profitability by reducing excess inventory costs and minimizing holding and stockout costs. That's all for today. We've just completed Module 6 of the CPIM course on the inventory management, covering 4 informative sections and their practice tests. If you're excited for Module 7, let me know in the comments below. You'll find all the materials and more than 2,500 practice test questions and explanations in the downloadable link in the description, so don't forget to take a look. Don't forget to give this video a thumbs up and subscribe to the channel. Your support means a lot.